Cosatu released radical plans for directing the economy yesterday. The union is calling for an overhaul of SA's monetary and financial policy, calling for controls over commercial bank loans and capping gold exports to increase national reserves. Joining us now is Dennis Dykes, and of course we are going to be chatting to Patrick Craven a little later. Unfortunately, we cannot get hold of him at this point in time. Dennis, thank you so much for joining us today. They're talking about radical changes at this point, and I mean, of course, capping gold exports to try and increase our reserves. As a whole, what do you make of the suggestions put forward by the unions?
Well, they are fairly radical. They really imply a much greater role for the state and a much reduced role for the market-based system. And generally, I would say fly in the face of the cumulative evidence of the last 50 years on growth and development economics.
Well, the basis of a lot of these measures that they want to put in place, of course, these are going to be discussed extensively by the ANC. Do you think some of them will be taken into consideration, given the fact that they are relatively radical, but they need to create dialogue as opposed to be just shunned?
No, absolutely. And within the policies, there's a whole raft of things which, I would actually tend to agree with. Obviously, the objectives of what they're trying to actually achieve, I think...
because it is about job creation.
Absolutely. And I think everyone's looking to try and achieve the same thing. So they, for example, on things like education, they talk about more effective education and so forth. And, absolutely, we all agree with that. It's really about the methods that I think I'd find a lot of differences with.
Well, capping gold exports to increase national reserves, do you think that's the way to go? Because central banks on a global level have started to accumulate gold as opposed to being net sellers, because we know for quite some time they have been net sellers. Do you think that would be a good option for South Africa right now?
Yeah, I must say I was a little bit puzzled by the idea. First of all, we actually do have a relatively large portion of our reserves in gold relative to other central banks around the world. And then really gold should just be one other currency within your reserve system. So, the notion that you'd actually be able to use it to actually buy other goods and services is not really different to whether you actually accumulate in euros or dollars. If you're taking a view on gold as being a fantastic investment, sure, but I don't think that's really the thrust in the document.
Okay, well, looking at the fact that they want controls over commercial bank loans to make sure that the banks lend priority to priority sectors, what do you think of that? That obviously could be a positive in the suggestions.
Well, yes, I mean, theoretically you pull the lever and the loans go towards the right sort of industries and the right sort of lending activity. The danger in all this, of course, is that it's not as simple as pulling the lever, because the availability of capital might actually start to dwindle if it's not perceived to be the right sort of industries that you're actually directing credit to. And if it's not priced correctly as well, obviously you could could lend itself to bubbles in certain areas and all sorts of inefficiencies, which is why most economists and indeed most growth commissions, like for example the Spence report, suggest that the market system is allowed to actually really prevail.
Dennis, also looking at the fact that they want a tax on capital inflows. Of course, the rand hitting 7.05 to the US dollar in yesterday's session. We're hitting those new highs. Emerging market flows set to continue. This is despite the fact that we saw an interest rate cut last week. So they want to see some kind of movement in terms of the appreciating currency. What can the central bank do at this point in time?
Yeah.
Do you think these suggestions are warranted? Do you think they would work?
Look, I mean, it's a concern among many emerging market economies at the moment, and I understand the concern. Some have, like Brazil, for example, imposed short-term taxes on short-term capital inflows, and this would be a similar sort of proposition. I personally think that the Reserve Bank could intervene more effectively in the way it actually intervenes, but that's a whole other debate. So again, I would actually share the objective, which would be a more stable and possibly more competitive exchange rate. But the danger, of course, of being too directed once again and too much of a control situation is you scare the capital away altogether.
But at the same time,
this
is it. They're talking about foreign exchange controls to be tightened because they're worried about the depreciation of the rand going forward. So it's obviously a balancing act.
Well, yeah, I mean, that just shows some of the contradictions in the document. Theoretically, you should be basically allowing more exchange to leave the country if you're worried about the exchange rate. But of course, then there's a concern that savings are leaving the country, and that's what we require. But it's contradictory. You can't actually have both. You've got to make up your minds as to whether you want to have the currency depreciating perhaps a little bit as a result of increased exchange control relaxation, or whether you want to actually keep those savings within the country.
Dennis, and looking at the inflation targeting notion as well, because that is what the mandate of the central bank is in South Africa. We know that various central banks globally have tri-mandates sometimes. We're starting to be relatively lax and to look at the growth scenario as well. But Cosatu and the unions have been very vocal about scrapping inflation targeting as a whole. We're lucky we're sitting in a low inflationary environment right now, but should that change, do you think that unions are going to get even more vehement about central bank looking away at that target of 3 to 6%?
Yeah, look, the idea of a central bank actually targeting inflation is quite simple. Lower, more stable inflation rates actually tend to foster economic growth. So there's never been a contradiction as far as the Reserve Bank's mandate is concerned. The danger, of course, is that you throw out inflation targeting altogether, or some notion of inflation targeting. Inflation soars, and ultimately you would be left with much higher interest rates than what we currently have, which of course would be extremely damaging in an economy that is typically prone to high debt.
Looking at the fact that the Reserve Bank could lose its independence under the suggestions that have been made, what is your view on that? Because what they're saying is that we need to see a state bank set up with control and ownership of the Reserve Bank's balance sheet.
Well,
what dangers lie in that?
The dangers is that the Reserve Bank has one instrument and one policy objective. And that is, the instrument is really interest rate policy, and the objective is to actually try and keep inflation under control. If you're now going to put multiple objectives on the Reserve Bank, it's difficult to see with that one instrument how they're going to achieve all those different objectives, and ultimately something is going to lose out, and I suspect it will be inflation.
Well, looking at the independence of the Reserve Bank, because there have been a lot of concerns about the shareholders and so forth, do you think that is going to change naturally anyway in South Africa, or do you think we're going to be sitting with the same strategy?
No, I think the same strategy will prevail. I mean, the shareholder issue, I think, is a bit of a red herring.
Yeah.
I don't think it's it's not a genuine attack on the independence of the central bank. The shareholders, in reality, should actually be a relatively dormant shareholding, in the sense that private shareholders clearly do not have a determination of monetary policy within the current regime, and I think that's really all that the central bank's trying to achieve there. At the moment, I don't see a danger to it, but clearly these sort of policies would threaten it very significantly.
Well, Dennis, taking a step back and looking at the most previous elections that we had in South Africa, there were a lot of concerns about policy changes and policy shifts, and of course the power of the unions going forward, and how that would change perceptions from a foreign investor perspective. Given the fact that we're starting to see these suggestions coming forward, we don't know if they're going to be taken seriously or taken into consideration, but what do you think that does to South Africa as a whole from a credit rating perspective?
Well, if they implemented, I think it would be devastating. Now, we've seen over the last couple of years, Venezuela, for example, taking fairly radical measures. The result has been a very, very serious recession, a complete flight of foreign direct investment, and a complete shunning of any sort of investment in the economy, with terrible consequences for that economy. So I would really, really be concerned if we're going to actually go anywhere down the similar sort of route.
Dennis, just very quickly, what was the biggest risk when it came to these radical suggestions?
Well, the biggest risk is that you cut yourself off from the global community, both from a trade point of view, as well as from a capital flow point of view, as well as from a sharing of knowledge point of view.